This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hi everyone, welcome back to another episode of Wealth and Toil. My name is Luke Laretive still, and I'm here with my good friend Dylan Pargiter-Green. I got it right?
You got it right. Episode 5. I'm so proud of you.
I'm proud of myself. I'm really proud of myself.
So proud of you.
How's your week been?
The week's been good. It's been we're just getting into the busy period of leading into tax time. I know it sounds really funny talking about tax time in March, but we do a lot of our sort of client annual reviews March, April, May, so that we've got time in June and the end of May to catch up with those clients that have more specific tax needs, particularly business owner clients, those sort of things those sort of people who probably need that extra bit of planning prior to end of financial year because perhaps they haven't put their superannuation contributions in as they should have, or we need to make sure that a certain amount of money might be allocated to a company. But yeah, no, it's been busy, mate. What about you?
Yeah, mate, pretty busy sort of end of last week and start this week so far. I've got a couple of days in Melbourne this week and
in the office?
I'll head back to Torquay towards the end of the week. Yeah, in the office. Just got a couple of meetings, catching up with a few companies and a few client meetings, which is good. Always enjoy that stuff. Be like you, I'm doing a few client meetings at the moment as well. But no, look, I'm just a bit knackered. I didn't sleep that well last night. Had a late basketball game and kept me up till all hours. And yeah, just had to get up early to get up to Melbourne. So
how many
can do without it. Need a good night's sleep.
How many points did we score?
Terrible aura score last night, 62, 63 on the sleep score. So not to my usual high standards.
Not your way.
Look, I can't complain. The parents I know would be laughing at me saying they haven't hit a 60 for years. So,
mate, how's the market been over the last week?
Mate, market has been pretty good. It's been up the last week. We've seen Aussie equities kind of move higher. We've seen international equities have a decent week too. And look, I think things are looking on the up at the moment. I suppose the bears are kind of chasing their tail a little bit. Continue a 5% bump in Nvidia last night. A little bit of negativity. Tesla down kind of 7%, but that suits my kind of narrative. So look, I think there's look, markets are supposed to go up, aren't they? And I think it's always interesting that we spend so much time on the downside, worrying about downside, and markets just go up 75% of the time. So, look, I continue to be bullish. We continue to be, trying to exploit some of the opportunities we see in the market every day, and made a few little changes to the portfolio. So, yeah, pretty pleased.
I think it's easy to maybe create a quote out of that. It's like, it's easy to be a long-term bull if you've got the conviction in place to stay steady. We've talked about that a bunch of times, but short-term downside protection, it is important in certain portfolios, absolutely. But if we're talking pure markets, it's sometimes the simplest strategy is the best one.
Mate, we're going to talk about asset allocation in a minute, and that's the best way to protect your portfolio. Is have an appropriate asset allocation for your risk profile and be properly diversified. And that's not over diversified. That's not diversified to the maximum possible amount. It's properly diversified. So we're going to get into that in a sec. So today's episode's all about asset allocation. We're going to talk specifically about how we build a multi-manager portfolio for a client. Particularly, we're going to have a look at international equities as a bit of a case study. That's not necessarily, the bill. We're not going to cover every part of it, but I think it's we can definitely tease out a few takeaways for people and a few points of interest and worth mentioning. But I thought we might start with the high level deal. Do you want to just talk to people and maybe you can explain a little bit how we think about asset allocation more broadly?
Absolutely. So, for those people who haven't looked at a portfolio of investments before or might have only dabbled in individual stocks, asset allocation simply means the different asset classes that we can put our money into that derive, different levels of risk and return. So, an example that's often used is defensive, something like bonds, versus growth, or something like equities. We'll talk a lot on this show about equities because it's the broadest asset class. It's what most of our accumulating clients and individuals are focused on. And it's also the asset class where we have the most flexibility to drive returns and see
Got the
growth
highest
in the
returns.
companies that we invest in. So when
Definitely.
we look at asset allocation, it is first and foremost a risk discussion. So at what stage of your investment journey are you in, and how do we allocate according to the risk appetite that you have? And then as a result of that, your risk appetite feeds your return appetite. So if you're in your 20s or 30s, you've probably got 30, 40, 50 years ahead of you of investing. Capital preservation at that stage, not as important as somebody who is 65, 70, retired, using their capital to draw on and needs a bit more stability. So in those younger stage accumulators and throughout that time of life where we're growing our wealth and we're building and accumulating and putting savings away, putting superannuation away, we're putting money into largely equities, listed property, listed infrastructure, maybe some things around private equity or alternatives. These are the asset classes where we're going to see higher than cash rate returns over the long term. The defensive asset classes, those ones that are, a lot less volatile, still have an element of risk, as we've seen with, bond prices changing significantly throughout 2022 and 2023, but derive their returns on usually a cash plus basis. So whatever your cash rate is plus a small premium for relatively stable returns. I'd say, look, one of the things that we often do at Bold is we really talk to clients about what their goals are, what their outcome that they're seeking is, and one of the things we look at is that really long term horizon of income source. So, where are you going to draw that income? It's probably the first part that we look at, because we want to seek what that outcome that they're seeking is. If someone comes to us and just says, I want to hit 15% every single year, we can sort of look at them and go, well, it doesn't really work like that. But what we
Right.
can do is make sure that you can draw at a certain rate in the future. You're probably in a different, position where you do have some of those people who are coming at you for a specific return. What do you say to them when we talk about asset allocation?
Look, I think asset allocation drives returns, right? So, a good place to start is look at global long-term returns for your key kind of benchmarks for each asset class, and have a look at beyond just historical returns, but also historical volatility, and some of the other metrics that we kind of look at, to give clients an idea of how different asset classes will perform during different environments, and how those asset classes will move relative to one another. By doing that, we can kind of create a relatively bespoke, and relatively confident, I suppose, risk return payoff for that client over time. It's not necessarily guaranteed, but certainly we've got a really strong basis for justifying why we're doing things the way that we're doing things. I think when clients get that into their head, that selecting managers or selecting stocks or isn't what drives returns. It's how much money you have in each bucket. That's the main driver of returns. Then you spend more time worried about getting your risk profile right and your asset allocation right, and that should remain relatively stable through time, as unless your goals and your life situation changes. So, once you've got those buckets kind of figured out and how much money is going to be in each bucket, then you can start to spend a bit more time drilling down into individual assets and the mix of those assets in a portfolio to generate the best possible balance of risk and return within the parameters for each individual client. But I do think people skip over the most important step, which is that asset allocation step, and want to get down to, well, should I buy this stock or that stock, or should I invest with this manager or that manager, or should I invest in, you know, emerging markets versus, you know, the US top 100 NASDAQ? Well, you're kind of missing the point. It's first off, what's in the bucket for defensive assets, what's in the bucket for growth assets, how much we're putting your money in each of those. Okay, great. Now we can make a decision of, you know, inside growth, how much we allocate into Australia and global, how much are we allocating to private versus public equity, how much are we allocating into, you know, growth alternatives. These are some conversations that we can start to have. But if you don't get that first bit right, everything else kind of doesn't really fall into place.
And I think it's interesting. You know, everything is often compared on a broad basis to a very similar benchmark. So when we're talking about like emerging markets funds, people will compare that to the Nasdaq, or people will compare it to the S&P 500 as a benchmark. They're gonna behave quite differently, right? So, but a small caps fund or
Yeah,
emerging
they're
markets
different
fund's got a
drivers.
different, yeah. But on a broad basis, people just see them as equities. People see them in this equities bucket. I don't think that's the right thing to do. And often, like I have to have conversations all the time, being like, this is trying to do something different to what our index-based funds, our core funds, are trying to do.
Yeah, I think I think a lot of the frustration, client, you know, difficulty, any, or, you know, people who are disillusioned with investing in liquid markets for one reason or another, comes not from poor performance. It's from poor understanding of performance, and it's from saying, hey, if you lose 5% of your money from the day you put it in the first year, does not mean you've made a bad investment. You know, it just means that, you know, the markets have gone against you that year. If the markets have gone down 10%, well, guess what? You know, you've actually done really well. By the same token, you know, if you've got a client who's got a conservative asset allocation and they're benchmarking it to the S&P 500, well, obviously they're going to consistently underperform. They're not taking as much risk as what is in the S&P 500. It's a completely different asset class. So I just think that, well, it's largely a different asset class. So I just think people get a little bit confused. They ask for a conservative portfolio, then they get frustrated with the low levels of return. They ask for a high level of return and then get frustrated with large drawdowns. It's unfortunately not a situation where you can have your cake and eat it too. You can have a little bit more cake and maybe get away with it. You can maybe eat a little bit extra somewhere, but you certainly can't have all cake, you know, and still eat at the same time. So I think you just got to be a little bit, a little bit
Should we
careful on that front, because it does result in frustration.
should we just go and get a?
Should we
I think
what?
there's. Should we go and get some cake from the fridge now? Because I mean,
Look,
I've
Bill,
got
we
cake
know
in the
you're a
fridge.
fan of cake.
I'm in my home office today, so there's definitely cake in the house somewhere. Sorry, mate. Oranges last week. It's really interesting though, right? On that point for asset allocation, you know, one of the big challenges for probably 5 years up until 2023 when rates started to rise, right? Interest rates around the world were near on zero. So people had to take this equity risk to receive any sort of
To generate
returns.
any sort of return.
We had defensive allocations within portfolios that were, you know, 1 to 3% year on year return. And if we hit, you know, 1.5 to 2% above benchmark, which is the cash rate being at zero, we were pretty happy with that. Very different scenario now where cash rates around the world are sitting at 4, 5, 6%. There's a lot less risk that has to be taken to achieve a similar result. How does that work within a
Yeah.
diversified portfolio?
Look, I think at the end of the day, you're just getting a higher nominal return, right? Like, so if I'm 30% invested in you know, defensive asset classes, I'm going to be receiving a much higher level of distribution from those income assets, and by the same token, companies are going to be required to pay higher or generate higher earnings or dividend yields on the equity side of the ledger as well to justify making additional contributions to that particular bucket. So it lifts the hurdle for all investments. It makes building a project harder. It makes making an NPV, a net present value calculation, stack up harder. But that's also part of the economic cycle, and this period that we're going to have of reduced investment will result in a period in the future of excess investment. It's just the way the business cycle works. So I don't think that it's a bad thing. I just think it's another thing that you need to be able to manage, and it's another reason why I think having an investment specialist in your corner can be useful in a really practical sense. Dill, can we just sort of keep the ball rolling here a little bit, because I want to get to some specificity around building out a portfolio. It's a big word for me. Building out a particular portfolio within an asset class. So, let's just sort of pivot a little bit. So we're on the growth side of the equation. We're not going to talk about defensive assets today. We will do another episode on sub asset allocation in defensives, and we're going to go to liquid markets. And what I feel like is one of the average Australian investor's biggest and most significant blind spot, and that's around international equities. I think it's a bit rich. I'll use the word rich to think that Bob from Q or Mary from Double Bay is going to be able to generate a sufficient edge in 40 to 80 global companies and significantly outperform, or sustainably outperform is probably a better word, an MSCI All World Index, which has got 5,000 odd companies in it. I just don't see that as being reasonable. There are managers out there that are running strategies that have been outperforming, but particularly when you start to throw in the unique and specific challenges of managing money in emerging markets, the various legal and regulatory frameworks that some of those countries have and deal with, as well as the language barriers and all the other things that go along with international investing. I just feel like either running a core satellite type approach where you use an MSCI All World benchmarked ETF and one or two external managers, or like we do at Seneca, a portfolio of 4 to 8 generally active managers who have a particular style of investing that we think's best positioned for the current environment, and you sort of willing to update and change those managers as you need to continually express your view, which is kind of how we do things at Seneca.
And that's a really good point, because if we broadly think about it, the average Joe doesn't have the time or resources if they are working another job that is not managing their own portfolio full time. And even if they are doing that and managing their portfolio full time by themselves, they don't have the resources to get access to, going and checking out a new power plant in India. Like you and me can't necessarily go and do that, but there are professionals who do 100%. It for their job, and that is their job to go and understand whether or not that is a good company with good assets that is worth investing because they are going to grow. So it is very difficult, though, particularly in international, because there are so many international managers covering such a broad spectrum of investment styles. So it's pretty hard it's hard to outperform the index.
It's a really hard benchmark to beat, and there's a reason why the hit rate of managers beating that particular MSCI or World Index is lower, because the way that look, this is probably too technical, and I'm going to probably regret doing this, but
we'll just cut it out. We'll just cut it out.
So no, it's relevant, right? But
no.
If you're managing to the okay, so I run an ASX 200, benchmarked ASX 200 limited portfolio, 20 to 40 companies. There's 200 companies that I can invest in in the universe, and I want to find 10 to 20% of the best 10 to 20% that I can find. Um, Now, if I was to do that at and I can understand, I can pretty much screen out 50 companies of the 200 just on numbers and say, well, that company's going backwards, that management team are a bit sus, blah, 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 and I can get down to 150. And then of that 150, I've got to get a diversified portfolio that covers off, a few sectors, so that I'm not just only investing in mining or only investing in financials, but I've got a bit of everything. And then I've got to, there's only so many set companies in each one of those sectors. So often I've got to decide between investing in 3 companies. It might be, do I want to buy, if I'm buying a utility, do I want to buy a gas pipeline, a toll road, or a railroad? Now, so all of a sudden my decision making becomes limited even more, and then I can do the work that answers that question and make a reasonable decision and give that a reasonable weight in the portfolio relative to the benchmark. If I want to play that same sort of game, a benchmark relative strategy, bottom up analysis at a 5,000 stock index level across multi-currency, multi-legal jurisdictions, like I'm at 500 to 1,000 companies, and I'm at every sector that's possible, every style of company. And I mean, there's no possible way that I could get across that many management teams, that many, quarterly results, that much history of financials. The chances of me missing something that's going to be really relevant and pertinent to my future investment returns, just goes from near zero to I don't know what number it is, but it's high. And I
that's
just
why
think just that fact alone, yeah,
that's
makes
why
it difficult.
yeah, that's why I think that you know a lot of the most successful managers have a really strong core thesis to their portfolio for things that they look for. A really obvious one is a quality manager will often screen out companies with high debt, and they will have a free cash flow measure on their stock choices. That screens out a
Yeah, so
hell of
like
a lot of companies.
a free cash cash flow return on equity or return on invested capital type metric.
Yeah, yeah.
Um,
So a good example of an international manager who, has built in some really strict guidelines might be someone who looks at quality businesses. So quality is a thematic that often gets thrown around. They will generally have very low debt in the portfolio. So we'll screen out companies with debt above a certain threshold, and they'll also have a high free cash flow return. So companies that are generating cash flow multiples on the equity value of the business.
I think that sort of approach, yes, you will screen out opportunities to invest in businesses that do well, and that is just par for the course. But what you need to do as a manager is to focus on something that you are good at, and I think whether that is Aussie equities, which we kind of do. Or if you are a global quality manager, maybe it's more of a developed market focused global quality manager, or you might be an emerging market specialist, but you've got more of a lean to India or China or South America or the Middle East. And I think that understanding the manager's area of expertise and avoiding managers who are telling you that I'm a generalist, I can do it all. I can go in and buy Nvidia in one day, and then I can
We
go
don't
and
do this.
buy.
We don't do that. We do whatever the
We
hell we
do
bloody
everything. We do
want.
everything. Yeah, like a really high discretion manager. I'm not saying you want a tight mandate necessarily, but I think you shouldn't need a tight mandate. What you should have is a person who understands the limits of their intelligence and their ability to outperform. And when you have, I mean, you want to be like a one or two trick pony, really. And when I look at we spent a lot of time over the last few years analysing fund managers, not because necessarily we're going to use them. We feel like it's our business. We just want to understand how our business works and what's been successful and what hasn't been successful. And I think that's pretty reasonable. But I'll tell you what is very successful in this job, and that is specificity. And I've used it twice in one episode, and that's how good I'm getting at this
So
podcasting
let's
game.
talk about something on that. Let's talk about something that clients will often come to me and go,
Let's talk about something important.
Sting. Clients will often come to me and we'll be going through a portfolio. We'll be looking at 3, 5, and since inception returns, but they will point to a 1-year figure and say, why don't we have more money there? So why aren't we investing more into that particular fund or that particular, ETF or whatever it might be for this person?
Product.
Yeah. The reason it's a big one, and you can talk to this in a lot of detail, I think. So I'm going to hand the reins over. But why is 1 year performance track record not a good basis for for picking a fund manager?
I think for starters, let's be clear, and clients will tell you between asset classes. If you've got a bond manager over here and an Aussie equities manager over here, they'll say whatever one did better that last year. They'll be like, well, why didn't we have all our money just in that?
Yeah,
and it's that's not kind of how that's not our job. Like we can't be, that's not really aligned with your risk profile to be investing 100% in one or the other. And we don't know what's going to do well this year or next year, or we can talk about history till the end of time and play the me uncovering the chart game. But there's no one in the world who can tell you that bonds are going to outperform equities or Australian equities are going to outperform international equities next year. It's not a realistic thing.
I think the other thing as well is don't go chasing waterfalls, right? Don't go chasing last year's return, because if someone's done really, really well, chances are that particular area that they invest in or that particular style had a really good run. That doesn't mean that the next year is going to do the same thing again. A great example of this would be commodity prices in 2022 versus commodity prices in 2023. At the end of 2022, all my clients wanted to be invested in was global resources, Australian resources, top 20 Australian funds. And we're going, well, that's done really well for you, but it's not the goal to just pick one specific sector. We play diversified so that we, on average, win in a different sector each game.
Yeah, I think the reality is that there's there's strategies that work and there's strategies that don't. In any given year, anything can work. Even a 2-year period, anything can work. I think what we're interested in is if you're going to make sectorial-based calls, my view is if you're good enough to pick a sector, you're good enough to pick a stock. So if you actually think that you know what you're talking about and you think that, okay, thermal coal is structurally supported, not that any of your environmentally conscious clients will want to be supporting any thermal coal manufacturers, but we'll have that argument another day. We'll put Luke's argument for why thermal coal is why thermal coal is. Well, why thermal coal is sustainable, and we'll be getting into that another day. Don't worry, there'll be plenty of time for that one too.
I've got an article here that was written by Luke Laretive. I don't know whether you've heard of him. He writes every now and then for Livewire. I think it's a supporting point, though, right? Interestingly, right? So of the top 20 managers over the last 3 years, only 2 at the time of writing were in the top 20 over the last 6 months. And the top 3 funds for the past 3 months at the time of writing were 244th, 126th, and 237th, respectively, over 3 years. So I think that goes to show.
That.
Yeah, that is data. That is hard facts. Hard facts. But it just goes to show, right? Like if you pick short-term returns on the basis for what you're trying to invest in, actually have some thought behind it. Actually have a reason why you think that particular manager or that particular area or particular stock is going to continue to do what it's done in the relatively short term. I think Luke asked me last week whether I would put money in NVIDIA, and I'm 5% up this week. So, suck on that, Luke.
Yeah, you're right. You deal with this game. You're wrong till you're right. So I'll continue to hold my position.
I'm wrong way too often to keep telling you to suck it. But I think that's a really important point, is that if you are looking to do this without help, please make sure that you're looking longer term. You're looking at what the fundamentals of the people that what they're doing and how they're investing, and try and get as much
Can I make
from
a
them.
practical suggestion?
Absolutely.
Can I make a practical suggestion on returns? If you want to look at returns and you want to look at historical returns, don't look at the 1 year and the 3 year and the 5 year and the 10 year and the since inception returns they put on the fact sheet. Forget about that. Ignore it all. Ignore it altogether. Go and find the top quartile managers across 1, 2, 3, 4, 5, 6, whatever. Pick a few, time periods that are relevant to you, and then grab the top quartile managers and ignore all their returns and don't care about the returns and where they rank, and then put them in some sort of software that you use. I use FE Analytics, but you can do it in other things too.
I use Luke's FE Analytics.
and look at rolling 3, 6, and 12-month alpha. So what that means is how much they're outperforming the benchmark by on a rolling basis. And what you want to do is you want to find managers who are above benchmark more frequently by higher amounts. And what that will show you is not that you should be investing with the manager who has necessarily generated the highest returns to a singular point in time, but in fact has a sustainable strategy that can outperform the market in a range of market conditions. The two things you will learn from that is that highest returns are not the best. And I say that, I'll repeat it again, highest returns are not the best. And the second thing you will learn is that no strategy works all the time, and that every dog has their day. And the reality is what you want to do is be on the dog who has their day more frequently.
I spit hot fire. I spit hot fire.
That is hot fire. That is hot fire. And that strategy, you will see that there are certain strategies that generate alpha or outperformance more frequently after fees than others. And they're the sort of strategies you want to think about including in your portfolio. And then you can get, okay, now I've got all the strategies that I want to invest in. I want a high conviction manager. I want a quality manager. I want a small mid-cap manager. Okay, great. Now you can get down to picking 1 or 2 managers in each one of those sectors and then allocating accordingly based on what you're trying to achieve. So I think that sort of thing is very practical and useful for people.
I reckon for the last 10 minutes then, let's talk about specifically 2 managers that we both have used in our client portfolios.
They are both currently in my the Seneca Global Equity portfolio.
They're both in the Seneca Global Equity portfolio. They both do similar things, but in a different way. So they both invest in what we would consider emerging markets. So ex-Australia, ex-US, ex-Europe. So the two managers that we're going to talk about are GQG. Fair bit of press on GQG.
GQG's emerging market strategy.
And Fidelity Asia. So
disclosure, can I make a quick disclosure? I'm a GQG shareholder, and so is Seneca Small Companies Fund, and so is lots of people of my clients. We own shitloads of stock in GQG.
Well, they've done really well. So disclosure, don't buy GQG unless you've sought professional financial advice.
From Luke.
From Luke. Just general advice only, etc. Reverse to the start of the podcast if you want to hear our full disclaimer and read it in the show notes. But no, we'll be comparing these 2 funds on a short and a long-term basis. The reason we want to do it is because they're both similar stories and they've got very different short-term returns. So, Luke, tell us a little bit about, I guess, each of the funds, a really quick snapshot, and then tell us what their 12 months performance has been, because it's pretty stark.
Okay, so you've got 2 of the best, and I'll put them in they're 2 of the best emerging market managers on the planet. Fidelity Asia is arguably the best manager in Asia going around. They've got, I think, $3 or $4 billion in that product. Dill maybe can pull up the fact sheet and confirm, but
fact check.
They're very good. Fact check that, but they're very good manager at what they do. We've been using it for a while, and it is benchmarked to the MSCI accumulation index for Asia ex Japan. And the manager is Anthony Schramm, and his background is much more, and his expertise is much more focused on Asia. And when I say Asia, I mean like the China, Hong Kong, Singapore, Indonesia type markets, Vietnam, the Philippines. This is where he gets his alpha. Korea, you know, it's not a he's not as focused on, say, like your India, South America stories, which GQG is. And not that they don't both invest in companies across those, but when we look at the portfolio, we can start to see what kind of companies they actually invest in. So if you're looking at Fidelity, his top holding is in Taiwan Semiconductor. He's got stocks like Tektronic, which make Ryobi tools, if you know that business. Yum China, ASML. So it is much more focused on Asian centric businesses. And, his returns for the last 12 months, just getting my numbers here, it's gone down 1.12%, against the sector, which is down 5 basis points. And he's ranked third at the moment in quartile. Over 1 year, he's in his first quartile across 3 years and 5 years, and his 5 year numbers are 6.27% per annum, ahead of the sector at 5.39%. He is the number 3 ranked manager in his peer group across 5 years on an annualized performance basis.
So just on that note as well, both of these funds have just over 1 bill under management. So they are like hundreds of thousands of dollars different. They're so close.
Okay, cool. So they're huge funds, right? Huge,
Yeah.
huge. $1 billion in a single product. There's a handful of those in Australia, realistically. So, we look at this manager. That over 36 months they've done 5.7% alpha at a sharp ratio of near zero, with 16% volatility. We can see a skew of their returns. Dylan and I've put all these fact sheets for you in the show notes. But the point here is that you would look at those returns and you would go, meh. You would probably say that is a pretty meh return, and a pretty average sort of performance. Not huge alpha. You know, sure, they rank well against other fund managers, but maybe I just don't want to invest in Asian equities at all. If I rolled that story out to you in the previous 10-year period, the numbers are completely different. And I think that's what people forget, is that what's happening today isn't always representative of what's happening in the future. And Chinese equities in particular are trading at 30-year lows at the moment. I said it in the last podcast. I'll say it again. I think there's a huge opportunity there when no one wants to invest in this stuff. It's exactly when you should be thinking about investing in some of it. Not every company is the same. It's a black box. However, I think Fidelity look really well placed to benefit over the next sort of 2 to 5 years from a recovery in Asian equities, ex-Japan more broadly.
China is a fantastic example of somewhere where active management plays a really strong part because of the fact that it is a bit of a black box, like you said, and the fact that, right now you've had pretty somber performance for the past few years as China's recovery from COVID was a fair bit slower than a lot of the sort of developed Asian nations, would we say? They had longer shutdowns. They tried to stay a lot more internal economically, and that's proven to be a bit of a drag on their economy and
drag on GDP growth.
Super drag on their market. So, Luke said it last. I personally find it quite challenging to invest in China because it is hard to see. But if I'm going to do it, it's because I've got someone who I believe and have confidence in doing that and doing it well. So last year we saw Japan do 34%. We saw India do 42, I think, percent in terms of their indexes. China still sat a bit behind that, and I mean, on a simple macro basis, again, not financial advice. Please don't go and do anything from this, but I would certainly be thinking about where the emerging markets play sits in the portfolio. Let's talk a little bit about GQG, because they have some similar holdings, right? And I've got one question to ask you on the GQG emerging market funds. They've got some similar holdings. They hold Taiwan Semiconductors. They've been in the news a fair bit for being big investors in Adani as well. Bit of a controversial one, but that has been an incredibly successful investment for them. Um, One stock that I have a question about is in the emerging markets fund. I looked this up this morning. They hold Nvidia in that fund.
Hard. So
How did
Nvidia's
that get
had
in there?
he's done so, mate. Look, you know, I don't like blowing smoke up other fund managers' bums, right? I really don't. But
You
Rajiv
should
from
though. You
DQG,
should. He is.
he's about as fucking good as they. He's about as
He
good
is
as
a
they
weapon.
get.
He is a
I'm
weapon.
gonna throw it out there. So he's a weapon, and I like it because he's got a unique skill set. He's uniquely qualified, Indian guy, by background, and I love. I used to sell a lot of coal to India, and I like, Indian business people. I find them quite easy to deal with as a general comment. But look, I just really like the way he goes about it. I really like the way that he thinks about companies. I love the way that he uses, his advantage over other fund managers in companies like Adani, which is, a behemoth in India, to generate alpha for his investors. He charges exceptionally low fees for what they do relative to the peer group, and he's building a behemoth of a business on the back of it. But look, the thing that's interesting here is, look, he's been on Nvidia early. He's making a lot of money out of that every month. But it's not just Nvidia for him. Like you said, he's on the Taiwan semiconductor thing, the Adani thing. He's pretty much the only fund manager of note who's backed that story on
And Brazil as
the
well.
accounting. And man, and Brazil, and look, you're preaching to the choir here. Like, I'm an ex Vale. Like Petrobras is like a oil and gas version of Vale. He's on Total Energies, making big waves in renewable energy and transitioning in Europe. I just really like the kind of companies he buys. I really like the way that he manages those positions through time, which he's underrated. And I like the fact that he's willing to do things that are seemingly unpopular and get into trades that are non consensus, and not so much that we're living and dying by the sword, but to enough that he can actually add value and add alpha in a large cap market that is, as we said at the start, difficult to outperform. So if you want a manager who's going to be diversified, his biggest weight in his portfolio is 8% or 8. I think it's 8.8 at the end of February, with
20
Nvidia going
stocks, I
up so
think, is
much. But
their goal for that fund.
yeah, no, a bit more, a bit higher than that, I
Oh, a
think.
bit more.
So
Sorry, no, I was reading. Yeah.
They've got a few more stocks than that, but the important thing here to think about is that they've got enough active weight, enough differentiation from the benchmark that if they get their stock picks right, they generate enough alpha to make it worthwhile paying them. So they've had a good track record for doing that. Like I said, I like the style and the approach, which I think is really important. And he buys the kind of companies that I want to own, and so that's why for me, we were investors in the GQG global large cap strategy, which is much more developed market focused. And we also use the emerging market strategy. We think they're two of the best products in the market. And, you're getting both for, I think, the emerging market strategies like, under 100 basis points, and the same for the large cap.
50 to 80 stocks is the holdings. I was reading a different fact sheet. My mistake. Mate, I just want to ask you one question. If you had to pick, but not pick between them, but those two funds are
Yep.
both in your portfolio. What do they do
Yep.
specifically that is different from one another? In really simple terms, why have you got both?
Yep. So we made with the decline in Chinese equities and the what we see is a highly concentrated rally in particularly US equities. We've made a decision to be overweight from our neutral position in emerging markets. So we were looking for more money in emerging markets than we normally have. With that being said, the reason why we have those two managers in the portfolio is because we have some governance rules around how much money or percentage of a portfolio we can give to a single manager. And we also genuinely believe that both can add alpha in different ways and complement each other without taking away from the outperformance. At the moment, Fidelity's kind of keeping up with their benchmark, keeping up with the overall benchmarks, and GQG is outperforming. But I can totally see a world in the future where we see sort of India and South America kind of taper off a little bit and be more neutral relative to benchmark, and Chinese equities and Taiwanese equities and Korean equities are shooting the lights out.
Yeah.
So that's why we have both. That's why we use both, and that's why we kind of think that having a portfolio of fund managers isn't about just making a selection, making an allocation, crossing your fingers and coming back in 12 or 24 months and hoping they've done well. It's a constantly iterative process that you need to manage. And I can tell you right now, we're making changes to global equity this month.
And it wraps this up really nicely because it takes back to what we said at the very, very start, which is, strategic asset allocation is what generally drives returns. But we've also got underneath that layer, you've also got individual selections of and layers of diversification that happen. If you go out and you just want full growth managers, you will find that they all hold some of the top 7 or 8 stocks in the NASDAQ in international, and you are paying, 1% to buy 7 different managers who are all doing the same thing. If you're looking to diversify that much, perhaps, think about using an index. The reason you want diversification and asset allocation is to do what our good friends at GQG do, our good friends at Fidelity do. They do something that is different. And we're looking for things that are different because that's how you drive alpha. So, mate, I think it's been really interesting. Hopefully,
if you don't,
hopefully everybody's found it, a bit interesting and insightful. I think that it's really funny. Before we started this episode of the podcast, we talked about how we wanted to make sure that we didn't go too technical. I think we used the term alpha one or two too many times. So apologies if people drifted off. Basically, think about your strategic asset allocation. That's what drives returns. And if you want more than that, go and seek advice. Come and speak to Luke. Come and speak to me, or one of our other team members.
We're happy to help. But look, I think you're right, Dill. We tried not to get technical. We got a little bit technical. We will maybe do a special edition in the show notes and add some things. But look, mate, always a pleasure. I really enjoyed that one. There are a couple of articles I've written about this on Livewire, which you can go and check out. And like we said, if there's any questions, please feel free to reach out. But otherwise, thank you very much for another good episode, my friend.
Mate, thank you. We promise we'll be a little bit more strategic, perhaps in the next one or two. Have a good rest of the week, mate.
Nah. You too, mate. Catch you next week.
See you, mate.